Welcome to the Youth Capital Podcast with your hosts Zach Swan and Jonah Wenzel. Join us as we dive deep into the world of finance, business and wealth creation. Please note we are not financial advisors. All information on this channel is not financial advice. All content created by Youth Capital is created solely for educational and entertainment purposes only. Consult with a licensed financial advisor before making any investment-related decision. Enjoy the show. Welcome to the Youth Capital Podcast. Today on the show we have Sam Koch. Sam is a Senior Equity Analyst at Wilson Asset Management. Wilson Asset Management is an independently owned investment manager based in Sydney that manages 8 listed investment companies and almost $5 billion on behalf of over 130,000 retail shareholders. Sam has more than 6 years' experience in financial markets. He holds a Bachelor of Business and is a CFA Charterholder. Before we begin, we are not financial advisors. All information on this channel is not financial advice. Consult with a licensed financial advisor before making any investment-related decisions. Wilson Asset Management may or may not hold a position in some of the companies that are discussed today. Thanks for coming on the show today, Sam.
Great to be here. Thanks for having me, guys.
G'day, Sam. What do you reckon sparked your passion for the industry, and can you give a bit of background on how you kind of got into what you do?
Yeah, definitely. So I actually came across the industry a little later in life. I was doing, during my last year of university, I was doing a fair bit of traveling, and this was back in 2012 and 2013, and you sort of pick up the fact that there's a lot of events happening globally, and I was just sort of really struck by the idea of trying to make money or investing alongside this. And this is what was happening with the sort of European debt crisis at the time, when everyone was worried about all the European countries effectively defaulting on their interest bills. So, I mean, I was captivated by that and really keen to jump into that. Even though I was finishing an unrelated degree in architecture, whilst I was traveling, I couldn't really sort of separate myself from that Bloomberg app and from like financial markets and trying to really unpick why things were moving at certain points in time. So I guess it was pretty obvious to me that I needed to jump out of that field and jump into investing. And, as soon as I did that, I enrolled in the CFA program, glued into markets, and then just tried to work my way towards that sort of buy-side career path.
So how did you get from architecture to your job at Wilson Asset Management now?
Yes, it's a long path, but it's it's a big change. To be honest, I jumped straight into any job that I could find in the investment space, whether it was front office or the back office, and I jumped straight into sort of fund administration and fund accounting. And that way you're across those products and you're doing unit pricing and you're trying to understand how the funds work, how the investment vehicles work. And that gives you sort of a solid platform to build off from that point in time.
Pretty good time to get into the market after the debt crisis as well.
Yeah, I wasn't thinking about market cycles at the time, but yeah, sure. It would have been even better to get into the GFC. Like, I actually wish I had have started investing earlier in my life, and wish I actually got on the investment train earlier in my life. But better late than never.
Yeah, of course. And today we're keen to get a beginner's guide for investing. If you can take us through the maybe 5 steps you'd use to get started investing. Yeah,
it's a really good point because, as I said, like, early on, even though you want to get involved, you don't know how to. Yeah, it's really hard to like, where do I start? What share do I buy? What platform do I use? All those types of questions. And it's really overwhelming.
Where do I start? What do I do? Yeah.
Where do I start? What do I do? And, like, do I buy, Square or Afterpay previously? Do I buy CBA? Like, it's just, there's so much information out there. I think what really helped me, and reflecting on that, is just sort of having a framework. And I reckon it's worthwhile using sort of like 5 steps to get started. For me, the fundamental question, the first question you have to ask yourself is, what are your goals? That's the first question. Asking yourself questions like, am I trying to save for a car? Am I trying to save for a house? Over what time frame am I looking to really achieve that outcome as well? Sort of helps you understand what your investment goals actually are. Yeah.
When you talk about, like, is that goal realistic? Because there's so much stuff out there on social media and like, oh, you can hear from mate, this company is going to do whatever 5 times or 6 times in a year, and obviously that's very, very unlikely in happening. Because I think it's important you do your own research and that realistic time frame. Can I make that whatever 10K or 15K in a year, or do I have to wait 2 or 3 years? I think that's an important part that you have to do a bit of research on as well, because there is so much stuff out there that's just get rich quick, and it's just not realistic at all.
Yeah, it's actually a quick way to lose money off those sort of little tips and that people give you. Because unless you do your own research, like, it's really hard to have your own conviction if a share price is going against you to buy more or to sell the position, whatever it might require.
Yeah. I
reckon the second step is trying to understand, how much time you're willing to invest to investing as well. This is really important, because if you're investing, if you're investing in the stock market, then you're probably going to be running up against people that are spending their whole entire careers, the whole days looking at the share market day in,
like
day
yourself,
out.
Yeah.
You're like yourself, but like the industry is huge. So trying to work out, whether you want to spend, 1 to 2 hours a week, is it 5 to 10 hours a week, or do you want to actually do it as a job? There's some of those questions that you probably want to help answer. And then ultimately, as we'll touch on in a bit, I'm sure, your portfolio probably reflects how much work you want to be doing on that as well.
Yeah, and ultimately that's going to really define your entire investment journey, how much time you're willing to invest.
Yeah.
And like what type of investor you are. I mean, I think we're going to go into that in a little bit further down the line, but how much time you kind of put into it really determines. I think there's a high correlation between the amount of time and, I guess, your risk tolerance. So obviously, if you do no research and you just want to put your money in an ETF or an index fund, you don't really have to do anything. But then if you want to, like you said, 20, 30 hours a week, you might be looking at your penny stocks or your smaller companies hoping for that high growth. So, yeah, I think that's quite an interesting point.
Yeah,
and people always say, "Oh, there's no time to invest," but we'll go into the alternatives later, like Wilson Asset Management role in that, and those people that want to get into the markets but don't have the time or don't want to learn.
Exactly. There's a range of products out there, from really cheap index funds to active managers as well, that sort of cater to people who are looking to outsource investment management effectively. But I definitely understand the excitement involved with picking your own stock and watching it go up, for sure.
Especially getting into it. Sorry.
Early, for sure. Yeah.
Those individual investors often can't, without a lot of knowledge, can't perform with the market over time either.
It's hard to. Hard to, for sure. Mate.
At the start of, especially people our age, between 18 and 25, looking to get it, they've gotten their interest from social media and seen these people making so much money so quickly, and then they think, oh, I can do this, I can recreate that, when it's just not really realistic in any way whatsoever. So, yeah,
it's definitely not easy. And when it feels easy, it probably is an interesting time to reflect on
100%.
On whether it's become too easy, and if everyone's making money around you, then it might be a good time to sell. Like, I think a really interesting anecdote was that, people who previously weren't in the industry, or people who weren't involved in markets, were making a lot of money on crypto,
Yeah.
And, tens of hundreds of thousands of dollars. And the question at that point is, like, has it, market's a little bit too loose? Has it become too easy? And then, unfortunately, we've seen what's happened in that space recently, which is the other side of that coin.
Yeah. And what's that quote? Don't confuse brains with the bull market. I think that's a good one to reflect on that.
I like that.
Yeah. And number 3, Sam.
Where were we? I've forgotten our steps. I think we're at number 3.
Number 3 now, yeah.
Number 3. So I think the next point is, like, so how much money are you willing to invest? This is really important too, because you don't want to bet the farm on something that, over time might not deliver on the goals that you're looking to achieve. Obviously, savings come first. The way I think about it is that, you probably want to be investing a small portion of the money you've saved up, or a small portion of your regular ongoing income. And you invest that money, and you sort of want to think about it as, I'm not going to touch that money over the next sort of 5 to 10 years. Mm-hmm. The worst situation you can.
Do you have a percentage of your savings, or a percentage of every paycheck you might put in, or something like that?
For me, I typically target 20 to 30% of my ongoing income on that. 20 to 30 cents of every dollar that you earn effectively. So I think the issue is that obviously if you invest more, or a lot more of your money, and you need that for regular things like groceries or shopping, or Christmas presents, or whatever it may be, then you might find yourself having to sell your investments to fund those purchases at probably the wrong time,
which is
always the wrong time in the market. Yeah. So
what about
the tricky bit?
A minimum amount that you think people kind of our age or in the younger investors sort of range should start with, like $1,000, $5,000, $10,000? What would you say is a minimum investment that would make your time and effort worthwhile?
I think always stay within what's relevant for that person's economic situation. I do know that the minimum that I use CommSec, and we'll get into that in a second, I'm sure. As a trading platform, I think their minimum's like $500
per trade, right?
That's because per trade. So keep that in mind. But I started with $1,500 in terms of some of my early investments, and yeah, so it just depends on that person's circumstances.
Yeah. And obviously bigger chunks offset brokerage a little bit.
Exactly. As you scale up. Yeah.
We'll go into different types of platforms, because there's all different types of, some have bigger brokerage with more information, or some have no brokerage with less information. It kind of comes back to what you're willing to get out of it. So I think we'll go into that a little bit later. What about number 4?
Step number 4. I better come up with 5 steps, otherwise I'm setting myself up for failure here. But, step number 4. So what type of investor are you, and what is your process? The process is a big, ugly word. So maybe I just start with what type of investor are you? And it helps you think about, like, am I checking the market every single day? Like, have I bought Westpac and it's up 2 cents and I feel like I need to sell it and take that profit? Or am I invested in it for the long term? So am I a short-term trader or a long-term trader? Am I like a value oriented trader? Am I looking for deeply discounted assets? Or am I looking for like a growth stock with growth potential? There's people that invest based on trying to pick stocks, and there's other people that invest based on, trying to understand macro trends and the like. And there's been plenty of macro trends over the last 3 to 4 years.
Yeah.
So I think, long story short, there is so many different ways to make and lose money in the markets. So I think just understanding the psychology and your own behavior is really key to understanding what type of investor you're going to be and what sort of fits with you. That's how I would frame that point.
For those who don't understand, can you just briefly explain what the difference is, say, between like a growth stock or, say, a blue chip, which is a term that gets thrown around a lot? For those who might not have heard those terms before.
Yeah, difference between growth stocks and value stocks.
Yeah, the industry tends to sort of split investors based on growth and value. And what that means is that, a growth stock is typically one that can grow, they can keep on growing for many, many years into the future. And they tend to be, pricier. They're more expensive stocks. If I think about CSL as a large cap stock in the Australian market that people might know, that is probably deemed, a growth company, and has, demonstrated that over a long period of time. On the value side of things, you're typically looking at companies that are a lot cheaper, that might not be able to grow every single year into the future. And that might be for a number of reasons. They might be facing, short-term headwinds. For instance, I'll give you an example. Event Cinemas, which is a company that owns, cinema assets around Australia. That is one that everyone thought that, Disney and Netflix and all those guys were going to heavily compete against them. And the history or the future of cinema was dead. And so for a while that was considered a heavily discounted value stock. Or it might be a company that might be facing, headwinds from a deteriorating housing market and the like. So I think there's two buckets there, but the way we like to think about it is that you can have value and growth at the same time by really doing your homework and really identifying what drives a company's share price and then where those underappreciated aspects of the company are.
I think it's
ultimately
to touch on
the end game is to make money in the markets.
Yeah.
I do think it's important to just briefly touch on the risk to reward ratio, because obviously with your bigger value companies, obviously you might only get between 7 to 10% per year, whereas with a smaller penny stock's a bit of a not a great word, but a smaller company that has higher growth potential, you might get 100% or you might get 50% per year. So, but then also the risk is they're linked, obviously positively correlated. Because a smaller company can very easily go to zero a lot smaller than, let's say, a CSL or a BHP or something.
Yeah, that's a great point. I think generally speaking, the large cap sort of universe of companies, like, the BHPs and CBAs, Woolworths and Coles of the world tend to not be as volatile as small cap and microcap stocks. So those smaller businesses listed on the ASX, you can still generate meaningful sort of returns from that space if you time things in the large cap universe. Where my team and I focus in on is the sort of small cap area, and we'll go into that later, I'm sure. That small cap area where you can get outsized returns if you pick the right companies. But obviously, as you said, they're fraught with risk. There's a lot of companies that don't do so well in that small cap area because they might not have the right management, they might not have the right technology or an established business.
It comes down to the amount of research, and like you said, you really have to do your research on the individual companies as well to try and find those. Maybe they've got a bit more debt than you thought, or the inventory's building up over the last few years, and that comes down to the amount of research and time you're willing to put into your stock picking or investing. So,
yeah.
And we'll get into some hard investing lessons learnt soon.
Yeah, definitely.
Yeah.
We've got plenty of stories to share there.
And number 5, least important of them all.
So what platform are you going to use? So how are you going to actually trade a share on the share market? So I use CommSec. It works for me just because I have the bank account tied up to it. But there are so many platforms out there that people can use. Some that I'm thinking about now is sort of like Raise, Stake, Superhero, Sharesies out of New Zealand, Self Wealth. There's heaps. So make sure, I guess, everyone does their due diligence. Everyone does their research on which platform suits them best. Some platforms won't charge you money for brokerage. The flip side of that is that you probably need to think about, if they're not charging me brokerage here, then they must be getting money somewhere. And the classic case of Robinhood exists where they sell information to hedge funds around trades. So just read I guess product disclosure statements in detail and do your research on the share trading platforms.
In terms of research, what do you suggest someone our age should look for when trying to choose a platform or a broker?
Yep. Work out how much they're charging you on brokerage as a starting point. So, work out what the flat rate is, or if it's a rate as a percentage of how much you're trading. From memory, I think, CommSec is like $10 or $20 for small trades. And obviously it goes up as you trade higher and higher amounts, but it's a smaller percentage of your overall trade. So there's that point. Secondly, sharesies, I know for a fact that in New Zealand, at least, they allow sort of fractional investments in companies. So if you can't afford to buy one share in a particular company and you only want to buy half a share, I think that's what they allow. It's some decent functionality there. And obviously, understand what these platforms are doing with your data is key. And then probably lastly, what additional functionality does it give you in terms of, do you want to trade the US markets? Do you want to trade, other global markets or just Australia? Does it let you do other things instead of just, straight equities? There's a bunch of things to look at.
Another important point there is if it's ASX chair sponsored, that means that the ASX actually holds your shares instead of the broker. So if the broker's holding your shares, not the ASX, if the broker goes under, it's not 100% clear what happens to your shares. So always check if it's ASX chair sponsored and if that's a concern for you.
Yep.
That's a good point. Well, thanks for those 5 steps, Sam. How important do you think it is to do, obviously it's important, but what type of research? Can you just give a bit of insight into, research into the markets?
Yeah, definitely. So I think it's really important. I want to underline that point a couple of times, just because I think doing your own research on a stock and making your own decisions helps you make sure that you're accountable to yourself, and then, effectively make sure that you improve as an investor over time as well. If you sort of identify how you've made good trades or investment decisions and how you've made bad ones. I've got a story, like when I first joined the industry, I invested, $1,500 into a little company called Megastar Millionaire. And to be honest, the tip-off came off from a person that I really respect in the industry. They'd done their own homework on the business and were making their own decisions based on that. I invested based on what they told me, and didn't follow up with my own work. Probably the best lesson I could have had, an expensive lesson, but the best lesson I could have had in the markets early on, just to understand, exactly where you see the growth potential in that particular business. And to give you context, it was a company that was trying to do Australian Idol for your mobile phone. All great in practice, all great in theory and all that type of stuff, but never really got off the ground. And unfortunately, I lost 90% of my money on that. I've got the check they actually gave me for when you become an insignificant shareholder. I think it went from $1,500 down to whatever it was, like $100, and they were like, "Oh, you probably can't sell your shares now, so here's a check." And so I haven't cashed the check. It's just a good reminder.
Yeah, I've got the chart here, Sam. It went from
Zach, you probably don't want to get that up for the listeners. Yeah,
it went from 30 cents in November 1st, 2017, and 1 year later, August 1st, it was 0.002 cents.
Good investment. Good tip off. I think everyone has at least one or two of those stories. It's just a tip off from a mate, or like that $40 million market cap mining company that's all speculation and exploration. And, when something happens, before you know it, you lose 90%. So I think everyone's got those. And people looking to get into it really have to understand that's going to happen 100%, especially when you're looking at growth and smaller companies like that. That's just a part of it. It's part of the game.
Yeah, exactly. Thought it'd just be worth touching on the fact that there was a little bit of insight after doing the CFA program and thinking about those sort of 5 steps and what that meant for sort of how someone would go about actually building a portfolio for themselves. Obviously, there's no advocates here for putting 100% of your money into a company like Megastar Millionaire, MSM. So interesting enough, and when I did the program before jumping into as I was jumping into the industry, they talk about it like a satellite approach where you effectively put, say if you had a pool of $10 that you're putting into the market, that you put the majority of that $10, whether it's 6 or 7, into a sort of a cheap index fund. You'd put a couple more dollars into sort of an active fund. And we can go into the details between what an index fund and an active fund actually is. And then a smaller portion again into, a couple of stocks around the edges that you've done the work on yourself and you have a high degree of faith in. And that sort of helps ensure that, I guess, you're getting, good exposure to what you want out of investing, whether it's, identifying companies, but also, and hopefully outperforming the index over time, but also sort of protecting and growing that capital base.
For sure.
You said that your team picks stocks, Sam. What does that mean? And can you take us through an example of what you look for and how you assess a management team?
Yeah, definitely. So good question around management teams, just because I think that's one of the most important points I've come
Very
across.
underlooked as well, I feel like.
Yeah, and it's also hard to quantify. When you think about, big, large quant funds or big, large computers that are trying to invest in the background and compete against, individual stock pickers like ourselves. Those computers, those quant teams can't place a number around how good a management team really is. Like, it's quite a subjective judgment, but I think it's really, really important. So yeah, one of the stocks that we've looked at in the past, we've owned shares in the past, is Brickworks, and it probably has one of the most impressive management teams we've come across in our space, purely because of the fact that they've come from a very cyclical industry. It's an industry, and what I mean by that is that their end market exposure, or where they sell their products to, is the housing construction industry. So they sell bricks to developers, and that can be quite cyclical. One year there's plenty of houses being built. The next year interest rates have risen. People aren't building as many houses, right? So it's quite volatile in terms of the sort of the revenue and the sales profile and the earnings profile of the business. But what Brickworks have been able to do over the last 46 years is maintain or increase their dividends for like the last 46 years, which is just phenomenal. If you're talking about sort of a management team that thinks long term, I can't think of many others that think as longer term as they have done. And I think, like, just as a pure comparison, this is a really easy way of looking at sort of long term, the value add of some businesses. If you chart their long term share price, Brickworks, versus some of their peers, whether it's CSR Group or Adelaide Brighton or GWA Group, you can see that the other ones are cyclical in the sense they can be quite volatile. Whereas Brickworks is probably, over the last 20 years, it's gone up, 4 times.
When you're researching the management team, Sam, what exactly, is there like certain things that you look for, or do you just do background research on all the board?
And obviously, Wilson Asset Management has an advantage over the retail holders. So how can retail holders also assess the management team without having direct contact with the team?
Yeah, it's a good point. I think I guess how we go about it should be no different to another person, how they would go about it, even if they didn't work at a fund manager and didn't have access to a management team. So the first thing I do is look at the board and management team, go through their LinkedIn profiles. Where did they previously work? Did they work there for a long period of time or a short period of time? Were their previous experiences a success, or were they failures? Then you could work out, you could look at the board construction and go, how many of those board members actually own shares in the business? How many of those board members are actually putting their money on the line instead of just, potentially collecting a director fee year in, year out? Same deal with management. Do they own shares in the business? Do they have skin in the game? Then you'd probably go through their years of presentations and go, okay, so back in 2016, they said they would do this. In 2017, they delivered on that. Okay, tick. Or they outperformed that, double tick. Or they missed it for a genuine reason, or they missed it just because. It's a cross against the name, right? So you're sort of building sort of an understanding of how these people within these businesses operate. And then I guess lastly, to your point, Zach, as fund managers that have the opportunity to buy large stakes in businesses, you do get access to management, and you get the opportunity to talk to them as well, interview them after their, the 6 month or their interim or their full year numbers. And you get a sense of, over time, whether they're telling the truth or whether they're lying to you. And it's just having that sort of filter and being able to understand, whether you're being lied to or not, effectively. And over time, you sort of build that repertoire.
We're keen to bring it back to Wilson Asset Management now, and why you joined the organisation, the good work they do, and what is an LIC structure, and how is it different to the traditional fund manager?
Great question. So the reason why I joined Wilson Asset Management was because, small company, high performance culture, but also because of the fact that they're really keen on honestly making a difference for investors, but also for the community at large. For investors, we have these listed investment company structures, which means that the FUM is, the assets that we manage on behalf of shareholders is actually listed on the ASX, which means that you don't necessarily see when the market's deteriorating or in a bear market situation, investors can sell their shares, but they can't pull money out of the vehicle. And so that means that us as managers are actually able to invest against the cycle, that we go from, at the bottom of the cycle, we're actually able to deploy capital and to get the best returns for shareholders instead of having less capital at the bottom of a bear market to invest. I think that's really, really important. So that's the listed investment company structure. And then on a further point to making a difference, there are two sort of charitable investment vehicles as well. They call them, Future Generation Australia and Future Generation Global. And what those do is they target investment and social returns. What happens there, instead of the asset managers charging a management fee of 1% of assets, so say you own shares in those vehicles, and you owned $100 worth of shares, and every year a typical asset manager would charge you 1%, so you'd have to pay $1 off to the asset manager to pay for their services. In these vehicles, that $1 doesn't go to the asset manager, it actually goes to charity instead. So there are actually no fees at all in the future generation vehicles. All of it gets donated to charity. And since their inception, probably 5-6 years ago, these vehicles have donated over $50 million to charity, which is just phenomenal and mind-blowing. So those are, I guess, that's one of the key reasons why I was so keen to join WAM and the work that they're doing community-wide.
Yeah. Awesome. And I'll have links to Wilson Asset Management down below and links to the Future Generation, all the good work you guys do. And yeah, the results for Wilson Asset Management speak for themselves if you want to take a look at the website. And our final bit, any advice to our listeners in order for them to stay up to date in terms of reading, podcasts?
Yeah, good question. Yeah, definitely. The fact that you're already listening to this podcast is a great step in the right direction, I think, just because listeners are keen to understand what's happening in markets and how to get involved. There are plenty of podcasts out there to listen to, but I think just starting early is a really good way of doing it. And then just reading, there are plenty of books out there. Expectations analysis by Michael Mabosson is a great way of thinking about how people price stocks and the expectations that are built into stocks. Staying on top of news and news flow across the market. So I actually use Bloomberg, all the print, AFR, Sydney Morning Herald, The Australian, Twitter a lot, just CNBC, anything to keep you abreast of what's happening in markets. And you probably, once you've got a taste for being on top of information, understanding how it impacts markets and how it moves markets, I think it's contagious. And it becomes a really passionate thing within your life. So obviously just my advice would be back yourself, do your own research and then back yourself, and then just work out, where you're making the right decisions and the wrong decisions, and then invest accordingly.
Yeah. And if you make the wrong decisions, where did you go wrong? And I feel like you either make money or you learn something, and then you can use that again to make some money in the next trade. So, I think it's a great point.
And a couple of the best podcasts that inspired us are the Equity Mates podcast and the Australian Investors podcast. I know we met Sam through the Equity Mates FinFest event in Sydney a few months ago.
Yeah, that was great.
That was a good event, wasn't it?
That was very good.
Really well put together.
Did you guys jump on the bucking bull at the end, or?
I didn't.
No,
I was way too tired at the end of that.
Yeah, we were there since the start.
I was by the end of that
finish.
thing.
Yeah. It was a long day, but there's some really good content.
I would have paid to see you on that thing, Sam.
Next time, mate. Next time.
Yeah.
Okay, thanks for coming on the show today, Sam.
I think that'll
do
us. Awesome.
Yeah.
Thanks heaps for coming on.
Thanks for having me on, guys. I really appreciate your time. And
pleasure to get to know you, get to meet you, and we'll hopefully have you on again at a later stage.
yes. Awesome.
Thanks, Sam.
All right. Thanks, guys.
Thanks. Cheers.